Now let's look at a basic introduction to the world of credit analysis. So just to get started with that, we first need to understand what is credit risk. We have been using it in quite a few sessions, but whenever I'm talking about a credit risk, it's basically the possibility of a loss for a company or for an investor because of the borrower. Any lender is exposed to a credit risk where the borrower of that particular lender is not making a timely payment of the interest and principal. Whenever the interest and the principal has fallen due, the timely payment of that is not done. That is where we say that the lender is exposed to credit risk. And more broadly, we look at this coming out as two components. One is called as a default risk, which is more associated with the probability that the borrower is not able to meet the obligations on time. And the second one is the loss severity, or more common word for this is LGD, loss given default. In case the borrower has defaulted, what is the amount of loss? What is the money that would be typically lost? So it could be expressed either in dollar terms or in percentage of the loan amount or percentage of the bond value. So what percentage is really lost? Because there is some possibility of recovery, because we know that every bond that is issued, in some cases there could be a collateral, so that collateral can very well be sold off to recover something. Even if it is an unsecured kind of a bond, if it is a secured kind of a bond, there is some amount of collateral for this. If it is unsecured also, there is a general claim on the assets of the company, so those assets can very well be sold off and some amount can be recovered. It's not that 100% that is lost. So every time we look at the credit risk of any particular company exposed to any particular borrower, we look at these two dimensions. One is the default risk arising from the probability of failing to pay. Then the second one is the severity, which is associated with the amount that is typically lost. In general, the multiplication of these two is sometimes called as expected loss. Expected loss is nothing but it is the default risk multiplied by the loss given default. So again, this could be expressed in percentage terms or it could be in dollar terms. And generally, whenever we are talking about the expected loss, it means that on an average, the loss for the company because of the default is going to be this much. So in reality, it could be much more than that or it could be much lesser than that. And whenever we are using another term called recovery rate, it is more and more closely related to your loss severity. In loss severity or loss given default, if I am expressing it in the percentage terms, 1 minus of that is what is the recovery rate, right? So this is what is a very basic overview of this credit risk. And what we typically see is if the credit risk is high, obviously the chances of default are higher. So who would be interested in investing in those kind of securities? So because of that reason, if the credit risk is higher, it is expected that those kind of securities should give high return, which means the yields on those kind of securities which are having a credit risk, higher credit risk, they need to be much higher. Typically, we see that the government securities, which are the treasury bills, treasury bonds, they are considered as risk free. Whereas the corporate bonds, they are having some amount of risk. So the risk that is the return that is expected on the corporate bonds is looked at from this particular perspective: risk-free rate, which is the treasury bond rate, plus some kind of a premium on the top of it to typically account for this additional risk that is coming up. Right? To account for this additional risk, there is an additional return that is expected, which is otherwise called as the yield spread. So the spread will be higher and higher if the credit risk is higher, and so the larger is the spread, the larger is and the higher is an indication of the credit risk associated with that particular security, right? So the higher is the credit risk, right? One more relation: credit risk is higher means yield spread is higher. So overall yield could be higher. Overall yield is higher means bond prices are lower, because we have already talked about the prices and yields following a negative relation. So here also we can very well bring out that there is a negative relationship that exists between the yield spread and the bond prices. As the yield spreads are increasing, the bond prices are decreasing, and vice versa. And we have also talked about the size of the spread. The higher is the spread, the higher is the risk associated, the lower should be the bond price. So this is where we talk about the spread risk. Even the spread need not be constant. The spread could widen in some cases, or it could narrow also. So the risk that the spread can change, and because of that that loss can come up, is more and more associated with the spread risk. Obviously, if the spread is narrowing, it is becoming more and more secured, safer. But only if the spread is widening, the credit risk is actually growing higher. And the spread is widening can very well be assessed from these two dimensions. There is a credit migration that is happening, which could very well result in downgradation of the company. The credit got migrated because of the change in the macroeconomic scenario, or in the way the company is working, or in the industry related scenario. So because of any of these things, the credit worthiness of the company has typically changed. It might have downgraded. The credit worthiness of the company has gone down during the period, which is what is the job that is taken by the credit rating agencies. We know that there are widely popular credit rating agencies like S&P, Moody, Fitch. They do provide different kinds of credit ratings for the different securities. So there might be a possibility that by assessing the financial condition of the company, the credit ratings might have been downgraded, or there might be a possibility of the market liquidity itself overall within the market. The cash is going more and more squeezed, and because of which I'm not able to sell the asset at the market price. If at all I have to sell off the asset, I have to compromise on the price. So this is what we are calling as the market liquidity. Even that liquidity risk coming up is widening the credit spread. So the spread is getting widened either because of the downgradation, or because of the market liquidity getting crushed up, which is resulting in a widening of the spread, which is again resulting in lessening of the bond prices across. So these relationships should be comfortable, should be something which we need to be comfortable with. And regarding the structure, every company, the debt structure, every company's the debt structure, there might be different kinds of debt associated. So we can categorize them under secured or unsecured. The ones which have collateral with them, we call them as secured. For those ones, they have a general claim on the all the assets, no specific claim on a particular asset. We call them as unsecured. Unsecured debt are typically the debentures. So the priority wise, this group will have a higher priority in terms of settlement when the company is typically going bankrupt or typically getting winded up, liquidated. So only after the payment of all these secured investors, the payments start flowing in for the unsecured ones. Again, in this we could see there could be something called as a first lien or senior secured or junior secured. So all of them, again, the priorities internally could change. The first lien is the one who gets the first priority in case of liquidation. Then the senior secured category, probably there could be some intermediately secured between a senior and a junior, and probably we are getting finally the junior secured or subordinated is what we call. So the order of flow is like this, and similarly we can create a kind of a structure here also. Senior, junior, subordinated. Again, the sequence in terms of the payments go completely in this way. So the seniors are getting the settlements first, then followed by juniors and subordinated. And what we typically see is all the bonds that are falling in one single category, they are treated equally. Right? At least there would not be any kind of a differentiation in case of settlement during a corporate bankruptcy that is happening. And obviously, whatever is recovered first goes to the seniors, which means the priority in terms of settlement is higher for them, which means credit risk is generally much lower for that senior debt compared to the subordinated debt, right? So as the seniority is going down and down, probably the priorities are going down and down, which is resulting in credit risk typically going up. It might very well be possible that only the senior and senior secured, junior secured, and probably senior unsecured are getting the proceed, and it might very well happen the junior unsecured and subordinated debt may not get any kind of proceeds also. So the risk is much higher with the junior, unsecured, and subordinated kind of debts. But in some cases, what we typically see in reality is, though the structure is fair enough, senior secured, junior secured, senior unsecured, junior unsecured, subordinated. So after the full settlement happens to this, the settlement comes here, then the settlement comes here, and in case only a little bit is left, it goes to this. They have these guys remaining is not paid to them, and these set of investors may not receive anything. That is theoretically, but in reality, what could happen is some small payment, some amounts could be paid even to these guys, even to these investors, even if they are not paid in full. Probably 90% could be paid to them, 80% could be paid to them, 30% could be paid to these set of investors. Sometimes this kind of a reorganization can very well happen. Though theoretically we talk about it's a waterfall kind of a structure, in reality there could be some kind of a reorganization, because what we see is the bankruptcy settlement typically takes long amount of time, and even there is a cost that is involved in it. So because of this, all the classes who are planning to lose, they come out with a kind of a reorganization plan, which may not be in strict line with the priority of the claims. So this is where some small structural difference can very well come up, and some kind of a deviation from the theoretical structure is very likely to follow, right? Now, when I look at the credit ratings that are typically assigned by the traditional rating agencies, important things that I need to look at is they majorly focus on the credit risk of the company and all the companies which are more or less similar from the dimension of the credit risk, they are rated, they are given a similar kind of a rating. Now here there are two kinds of ratings which we need to carefully look at. One is a issuer based rating, the other is issue based rating. Issuer based is more of a rating to a company as a whole, whereas issue based is to that particular security. So if the company has issued five different bonds, five different bonds of five different maturities, right, and five different seniority levels, then what we could see is the ratings that are associated to these five bonds are different as a part of the issue rating. So this issuer ratings which are associated to the whole company, they are called as corporate family ratings, because the whole family is getting rated in this particular, whereas here we call them as corporate credit ratings. Only a particular issue is getting rated here. So any new bond the company is raising, existing bonds, they are provided different kinds of ratings here. So here it's the whole company and the credit worthiness of the company is looked at, whereas here only that specific issue is looked at. And when the focus is on the whole company, it is looked at from the perspective of the senior unsecured debt of the company. Whereas whatever is the issue, whatever is the specific issue, whatever is the seniority of that issue, a rating is provided to that. And of course, we know the most common ratings AAA, AA, A. Then we talk about triple B, double B, B, triple C, double C, C, and a D. Now, each of them has from here onward there is a plus, and I mean there is a AA plus, AA, AA minus, A plus, A minus. So there could be three categorizations of each of the groups, right? So this is how the S&P provides the ratings. This is how the Fitch provides the ratings. Whereas when it comes to Moody's, it's a slight different. They provide it, okay, this they provide as capital A followed by two A's, and let's say double A if they want to go with, they simply say capital A, they call it A1 for plus, A2 for normal, A3 for minus. Similarly, within the A category, they talk about A1 plus A1, A2, A3. In the B category also, triple B, they come out with BAA1, BAA2, BAA3 kind of categorization for plus, normal and minus. So they always try to position it in this way. And what is very much understandable, necessary for us to understand is anything above this grade from AAA to up to triple B minus. This is called as the investment grade. So a categorization comes, any rating up to this is called as the investment grade. Any rating from here onwards is called as the speculation grade or non-investment grade, and in some cases they are even called as high yield bonds or junk bonds. So different kinds of names associated with the bonds that are falling in each of them. And anything that is getting a D rating is actually called as default category, and there is always a possibility that one of the bonds defaulting might trigger the default on the other bonds also, and that is what we call as cross default provision. One of the bonds in the group defaulting will have a triggering effect on the other bonds also, which could be typically called as a cross default provision. And there is a possibility that the different issues can have different ratings. And this particular process where a rating agency provides different issues with different ratings is actually called as notching. So different issues carry different ratings from the same issuer. Seniority, the highest senior one will get a better credit rating, the lowest one will carry a worse credit rating. Normally, for if the issuer rating is very high, if the issuer's credit quality is very high, probably notching may not be applicable. All the separate issues also will have a high rating itself. Only when I see that the issuer's ratings are lesser, this is where I observe that the notching is a prominent thing, because some of them will get a very good credit rating, some of the issues may not get that good a credit rating. So that is where the issuer and issue related ratings and the importance of notching needs to be looked at. And there is one more important thing that needs to be looked at, called as structural subordination, which we really need to assess in a better way, because this is more and more applicable for a parent and parent and subsidiary kind of companies. Okay, parent is having some senior secured debt or senior unsecured debt and junior unsecured debt, and the subsidiary is also having senior unsecured debt, junior unsecured debt. Now, if the rating typically, if I have to look at subsidiary transfers the amount to the parent. Now, the indenture of the subsidiaries bonds could very clearly specify, could provide some kind of covenants which will restrict it from transferring the amount from here to here, which means the payments to the senior unsecured debt here will get happened only after the junior unsecured debt here is typically getting paid, which means even though it's a senior unsecured debt here, from the perspective of this, it is still a subordinated kind of a debt itself. So while doing the ratings, the credit rating agencies would typically understand all these kind of complex structures and then they design the rating formulas for them, right? And with respect to the ratings, obviously there are a few important points, or typically the risk that needs to be focused. One, the ratings are more and more dynamic in nature. They keep changing because the performance of the company will keep changing. So the rating agencies have to really update themselves with the happenings of the company and try to keep changing the ratings as and when there is it is sensed that some kind of goodness or badness is associated with the performance of the company. So it is also seen that the companies which are having very good credit ratings, more or less in a very high range, they are more or less stable, very rare that they fall down, very rare that they move up. But the companies which are having moderate credit ratings, what they see is their fluctuation within 1 year, either to the upward side or the downward side, the fluctuations are much higher. So, from the rating agencies' perspective, they have to be more and more focused on those non-highly rated kind of companies, because they over time the ratings can change quite drastically, and there is a possibility of the rating mistakes that can come up. Right? Sometimes overrated, sometimes underrated. So there should be some word of caution that is built into it. It is really felt that these credit ratings, they lag the market price. See, sometimes the market might have already reflected the news about the company. Either increase or decrease in the performance would have already reflected in the price, but the credit ratings are very slow to that change. They did not change the credit rating, but from the market's perspective, the price has already got reflected. So we really need to evaluate how the market price got reflected because of the performance, because credit ratings may not reflect that change quite immediately. And in some cases, the event risk, some kind of fraud happening within the firm, some kind of natural calamities, some kind of disasters occurring specific to a company or industry, they go very difficult to anticipate and predict, which means in those cases the ratings whatever they are given, they don't consider all these kind of extremities or all these kind of uncertainties, so the ratings may not be a true reflection of the performance. So while the ratings which are provided by these rating agencies need to be taken with a pinch of salt, it is very much necessary for us to understand that these ratings in general provide a broad overall assessment of the credit risk of the issue or the issuer. All right. Now let's look at the process of the traditional credit analysis. And whenever we are first assessing the traditional credit analysis, the first part which is typically looked at is the four C's. The four C's of credit analysis going with the capacity, the collateral, then the covenants, and the character. Four different dimensions that are defining the components of credit analysis. And as a part of the capacity analysis, there is a lot of financial ratio based analysis that is performed. So even that goes into the traditional credit analysis. So we'll take one by one. We'll try to work out on these two aspects, right? So initially, starting off with the four C's. As I said, capacity, collateral, covenants, and the character. So capacity I'll take to the last, because we will be integrating it with with a few financial ratio computations as well. So we'll look at the collateral. Collateral is a kind of security that is being provided along with the bond issue as a security in case default happens. So more and more collateral is provided. It is considered that the company which has issued the bonds is very heavily credit worthy. So collateral is a measure of the credit worthiness. But sometimes what happens is a lot of things which are the assets of the firm, they are very difficult to observe. Probably the intangible assets, they could be very heavy for the firm, but they can't be observed, right? Probably they could be of high quality. Some of them, let's say patents are treated as high quality intangible assets, whereas goodwill cannot be treated as any high quality, because patents can be sold at any point and generate cash, whereas goodwill can only be impaired. So probably some kind of an adjustment also can be done, wherein the goodwill can be written down and the recomputation happens. Then one more important point while assessing the collateral is the depreciation to the capital expenditure. If this ratio is very high, it means that either the capital expenditure in the company is decreasing, no new capital is getting invested, or these assets are going more lower and lower in value. So which could very well lead to the high loss severity in case a default is going to occur. So the higher is this ratio, it could be an indication that the total assets of the company are typically going down, which could very clearly signal a kind of severity in case a loss, in case a default is going to occur. Similarly, if the from an equity market perspective, if the market value is very much lesser than the book value, even that could very much indicate that the real book value, the real value of the assets are of low quality. So even if those assets have to be liquidated during the financial distress period, probably a big loss is bound to occur. And the other dimension is with respect to human capital, though it is not shown in the financial statements, it might very well be a powerful function which can act as a collateral. So, from a collateral perspective, these different dimensions and these different issues need to be specifically looked at. And when we talk about the covenants, we talked about them earlier. These are some kind of do's and don'ts from a company's perspective, which are the kind of agreement between the borrowers and lenders. To a large extent, they protect the lenders, but at the same time, they do not restrict the borrowers to a very large extent that they can't even make the payment. So there are a few positive or affirmative covenants which talk about what should be done, like regular payments of interest and the principal, or they may talk about maintain the ratios within this particular limits. These kind of things go as affirmative covenants, whereas there could be a few negative covenants as well, which restrict the firm from doing as long as the bond is intact. So probably they should not go for additional debt or some kind of special dividends. They can't issue special dividends without consulting the bond investors or without the approvals. So what are the kind of covenants that are available with the particular bond issue will really categorize or will really position the bond appropriately on the credit line. Similarly, when I am talking about the character, it's purely the management's willingness to repay. Here there are two dimensions. Management's ability to repay, generate cash to repay the loan is a measure of capacity. But the willingness, commitment, the behavioral issue is more a function of character. So probably looking at the qualifications of the management, right? The operations record, the past record in terms of when they were, whether this management team was involved in any other bankruptcies, any other restructuring kind of scenarios. How aggressive is their mindset towards profits and risk management? What is the soundness of the strategy which they have typically developed? What are the kind of accounting policies, tax policies that they follow? Are they hiding any of the transactions? Any past record of the fraud associated with the existing management? Any kind of auditors changing quite rapidly? All these things which are character related issues, and did they follow in how well are they treating the bond investors? Are they providing more and more dividends to the equity investors at the expense of the bond investors? So primarily from a behavioral dimension, from the character dimension, we can assess the management. That is what is being reflected as a part of the character. So even that needs to be analyzed. But yes, the capacity which talks about the ability of the borrower to really repay the interest and the principal once it falls due. Typical capacity analysis focuses on three different dimensions. One talking about the industry structure itself, what is the composition of the industry. So basically the Porter's five forces model is what is applied to evaluate the industry structure. What is the kind of rivalry that is existing in the competitors, What are the bargaining power of the buyers in the industry, bargaining power of the suppliers, right? And then we have what is the threat that is coming from substitutes, and what is the kind of threat that is coming from the new entrant. These five forces of Porter's model are very cleverly will need to be analyzed to typically understand the industry structure. Then we also talk about the fundamentals of the industry itself. Overall, as the industry, what is the kind of influence of the macroeconomic factors on the growth and profitability? So is the industry more and more cyclic in nature? Because macroeconomic factors will really affect the cyclic industries very heavily compared to non-cyclic, where during recessions the industry will get damaged very drastically, whereas during an economic boom this industry also will flourish heavily. So understanding the cyclicality of the industry, growth prospects coming from various reports, various public statistics, right? Because a company which is falling in a very weakly growing kind of an industry, and a weak performing company, probably the creditworthiness will become a big question mark. So understand the industry fundamentals thoroughly. Then probably there is a look at the fundamentals of the company itself. So it could start right from understanding the market share. How is it changing over time? Is it increasing or decreasing over the last few years? The cost structure of the company, is it increasing or decreasing over the past few periods compared to the competitors? What has been the performance of the company over the last few years? How did it perform during the business at different business cycles during a recession? How did this company perform? What is the kind of management the company is having? What is their strategy? How much effective is the strategy? And what kind of impact their strategy? Is it more aggressive, more conservative? What kind of impact this strategy has on the performance of the bondholders? And finally performing some kind of numerical analysis on the various financial statement, computing different kinds of ratios. Typically we can see that there are different leverage ratios and coverage ratios that are computed to really assess the credit worthiness of the company. Right, so this is a typical three-dimensional approach associated with the capacity analysis, which in turn is one of the most important aspects of the traditional credit analysis of the firm. So looking at it in much more detail, so we'll try to compute the ratios, and the intention behind computation of the ratios is the comparison. The comparisons generally are done with three things: over time for the same company, how did it perform, what is the kind of trend in its performance. Then it is looked at with respect to the peers and even the industry standards if there are something. So all these comparisons are typically done, and some of the important calculations that are done from a credit perspective. One is EBITDA. These are some of the measures of profit or cash flow which are typically used as a base in computing the ratios. So EBITDA, as we know, earnings before interest, depreciation, taxes and amortization. So logically it is nothing but the operating profit or operating income. I add back the depreciation and the amortization. But the biggest problem is this does not consider the capital expenditure that has been done, and this does not consider the changes in the working capital that are done during this particular year. But those are the two important calculations So this has the limitations. The EBITDA, using the EBITDA as a measure of the ratios for credit analysis, is limited because of it's not using the capital expenditure or the contributions to the working capital. On the other dimension, I can look at funds flowing from operations. Right, funds flow from operations is primarily looked at as net income plus depreciation plus amortization plus deferred taxes plus non-cash. It is more like cash flow from operations, but of course here it does not take into consideration the change in the working capital. Cash flow from operations typically consider the change in the working capital also. So this is as good as cash flow from operations minus the change in the working capital. Even this one does not consider the capital expenditure that has been done. So this is one more measure that goes as a part of the calculations of different ratios. Then the most common one that typically gets in is the free cash flow, either before dividend or after dividend. The free cash flow typically goes like net income plus depreciation plus amortization. It will adjust for capital expenditure, and it also decreases for the change in the working capital. So this is the typical cash that would be available for distribution to the investors. Right, this is the cash that is available for distribution to the investors, probably the bond holders as well as the equity holders. So if this is much higher than the bond holder equity holders amount, or if this is higher than the amount that needs to be paid to the bond holders, then the company is sufficiently having cash to typically pay to them. In some cases, it is even looked at with a perspective of after the dividend. From the simple dimension, whatever the free cash flow before dividend is there, if I subtract the dividend, any positive that is there, this positive, it is like it can very comfortably be used to pay off. It can comfortably be used to pay off the debt. So the debt can be retired, some kind of buyback can happen. Even if it is not getting retired, it can accumulate. So it is a positive signal itself, which will reflect that the company is having the potential in terms of repaying its interest and principal quite comfortably on time. So that's one of the reasons the free cash flow after the dividend is being looked at. The higher and the positive it is, it's a good signal that the company will be in a quite comfortable position to do the payoffs in the future. Now, looking at the specific ratios, right? First, let's look at the different leverage ratios. So leverage ratios, first of all, are a measure of debt and equity, measures specific to debt and equity. And debt, we actually, in some cases, as a financial analyst, we have to make some kind of an adjustment. If there is an underfunded pension plan, that needs to be added back to the debt. If there are any kind of operating leases that are there, they need to be added back, and any other off balance sheet activities that are denoted, even they need to be added back to the debt. And once this adjustment, so the initial step is make the adjustment to the balance sheet, and after that try computing either the debt to total capital ratio, which talks about the total percentage of the capital that is funded in the form of debt. So if it is much lesser, yes, the credit risk is much lesser. The higher it is, the credit risk is much higher. But here there is a suggestion. If at all the goodwill of the company is much higher, It's better that there is an adjustment that can happen for the goodwill. Make it like completely written down. Do the adjustment to the equity accordingly. Otherwise, equity will be much higher. Debt to total capital looks much lesser. So it is suggested that if that goodwill kind of intangible assets are much higher for the firm, just try to adjust them by writing them down completely and adjust the equity accordingly and compute the debt to equity. That is the reason it is that kind of a calculation is called as a second debt to capital ratio, and try to do the assessment on the soundness of the credit risk after looking at the second debt to capital ratio itself. Then it is mentioned that you can even evaluate debt to EBITDA ratio. EBITDA is the profit, debt is the loan that has been taken. So, compared to the profit that the company is generating, if the debt is very high, it's an indication of the credit risk. The paying capacity of the company could be much lesser if the debt is forming a significant portion compared to the EBITDA. Right, so the higher it is, it's an indication of high credit risk, and probably just not high. In some cases I could see that this ratio will be even more volatile, especially for cyclical firms, because for cyclical firms I observe that the EBITDA in a few periods during a recession, it goes down drastically, it goes up drastically during a boom period. So the ratio can fluctuate quite weirdly for cyclical firms. So that's one more thing that needs to be considered while evaluating the credit worthiness of the firm. Similarly, there is one more ratio that comes in, which is the funds flow from operations divided by debt. So how much cash is generated by the operations as a proportion of debt? The higher this value is, the higher would be the paying capacity of the firm, because it is able to generate a very good fund from its operations. So its paying capacity is actually going up. So credit risk is typically going down. So some kind of assessment of these different ratios need to be done. And what we generally see is the credit rating agencies, they specify some kind of percentages. They specify some kind of percentages for each credit rating. Okay, if I am talking about a AAA credit rating, what should be the traditional debt to EBITDA ratio? If it has to go with A plus kind of a credit rating, what should be the funds flow from operations to the debt ratio? So for each kind of a credit rating, it is very clearly seen that these different ratios will have a number that is provided by these rating agencies, which can really help us in terms of assessing whether this company can potentially have a chance for either improving its credit ratings, or probably will are they going to worsen in the future. And if they have to improve it by, let's say, 1 unit, what should be the typical debt to EBITDA ratio that they need to target for the next period? All these different dimensions can very well be analyzed by the analyst, which can act as important tools for decision making by the management. On the other dimension, probably there is a set of coverage ratios that are looked at. To a large extent, they talk about to what extent the company is able to generate the cash flows and profits to typically make the payment for the debt. That's the reason we talk about two ratios. One is EBITDA by interest expense, and even more and even more a conservative version of it, EBIT by the interest expense. So obviously, because EBITDA will be greater than EBIT, because it even includes depreciation and amortization in it, this ratio is more aggressive, this is more conservative. And the higher it is, it means that the company's paying capacity, company has generated this much of profit, whereas it has to pay only this much of interest. So as long as EBITDA is greater than the interest, it indicates that company has generated a profit which can help it comfortable in terms of paying the interest on time. Right. Similarly, EBIT also is talking about the same, but more or less on a slightly conservative kind of a basis, because here it is talking about the earnings before only interest and tax, but it does not include the depreciation part. But all these ratios, one, they need to be compared with respect to the past, a trend analysis, the peer-to-peer analysis need to be performed, and some kind of industry averages can be used for verification of these ratios. So very commonly we see that the debt to EBITDA ratio, EBITDA to interest, which is a coverage kind of a ratio, free cash flow to debt ratios, debt to capital ratios, leverage coverage ratios are computed for each of the years compared, and that is where the overall credit analysis of the firm is typically getting performed. And there could be some kind of comparisons with what are being published by the credit rating agencies to get a broad overview in terms of what should be the target numbers in case the credit rating needs to be increased, or in case to what should be the worst case performance to make sure that the credit rating does not fall beyond below this particular level. So all these dimensions can quite comfortably be analyzed by looking at these various financial ratios, right? So this is what I would like to offer as a part of the understanding of the traditional credit analysis. All right. Now let's look at some of the important points regarding the yields and the spreads while performing the credit analysis. So before we look at in detail, we know that the return on a bond or a yield on a bond, I can very well write it as the risk-free rate of return, which is real, plus expected inflation, plus maturity premium, plus liquidity premium, plus default premium. So this is a typical way the yield on any security should be looking like. So the real risk-free rate of return, the expected inflation, a maturity premium, the longer the maturity of any security, the higher should be the maturity premium. The liquidity premium, talking about the ability of that particular security to be sold in the market without any compromise on the price. And finally the default premium, measuring the probability of default and the expected loss that can typically come out in case of a default. Now if I look at it even more in detail, these three, any change that is happening to these three, they are more and more macroeconomic kind of factors, so which could result in the yields of all the bonds affected accordingly. Even the government securities get affected if there is a change in any of these three areas. But these two, they are more and more company specific. So any kind of a change in this is more and more contributing to the spread, and any change in this overall yields of all the bonds across the market are changing. So here we are more and more focused on these two aspects, the liquidity premium as well as the default premium, which are contributing to the spread. So while assessing the spread, there are a few important points that needs to be evaluated. Look at the credit cycle. We see that it is more and more cyclical in nature. So when I say cyclical, probably at its peak of the cycle, Probably it is looked at that the credit risk is much lower and it is more and more bullish. So because of which the spread is going to be much narrow. But at the trough, at the when the economic cycle, when the credit cycle is more or less at its trough, there is a deterioration in the credit, which could result in the credit risk typically going up and the spread is also typically going up. So understanding where in the credit cycle today the situation is. And another important analysis to look at is the state of the economy. Is the economy right now going through the strengthening position? Is it strengthening period over period or is it weakening? The more it is strengthening, I see that the credit spread is going to narrow down because the credit risk is typically going down. And the credit position of the company is going to improve in this particular scenario. So look at the economy. Is it going more and more towards the strengthening phase or is it traveling towards the weakening phase? Look at the equity market performance and in general the financial markets performance. The moment the equity markets are more and more bullish, right, more and more bullish, we see that the credit spreads are narrowed, credit risk is narrow because the equity can be sold to pay back the bonds. So the credit spread is narrow, credit risk is narrower. But the more and more the equity markets are bearish and they are not performing to the expectations, weak performing equity markets, I see that the credit spreads are going to widen. But if the equity markets are more and more stable, what I could typically see is the volatility of the yield. The yield volatility is going to be much lesser, which is also an indication that the credit spreads can be narrower because the credit spread is more associated with the volatility as well as the actual yield changes as such. Then the amount of capital that is available with the market makers, broker dealers supplying the capital, more and more capital is supplied. We see that the credit spreads are narrowing, but if the capital supplied is much lesser, the credit spread can widen in the market. And the typical economic concept of demand and supply, if there is high demand for bonds, right? If there is high demands for bonds, obviously the investors would be comfortable with even with a lesser yield on it, which means the credit spreads are going to narrow. But if there is excess of supply compared to the demand, obviously the lenders have to, the borrowers have to pay a premium for getting access to the borrowing, which means the credit spreads are going to widen in this case. But in all these situations, the credit quality, the better is the credit quality, the lesser is going to be the credit spread, and the yield volatility is also going to be lesser. And exactly the opposite in case the credit quality is worsening. And as we have seen earlier, the spread, the way it impacts on the return, we have earlier computed that the impact on the return I can very well look at as minus of adjusted modified duration. I multiply it minus adjusted modified duration. I multiply it with delta spread plus half convexity multiplied by delta spread squared. So this can give me the change, the impact on the return because of changes in the spread. Because I am looking at the magnitude of the spread and also the price sensitivity of the bond because of the spread. Both of them are contributing to the percentage impact on the return because of the change in the spread. So I have to look at these two numbers critically for typically arriving at the impact that could be there on the bond price. And a few more interesting points that come out in these in this context. If the maturity is much higher, I see that the adjusted modified duration will be much higher, which is resulting in the spread being more and more sensitive. So the prices are going to be impacted quite drastically because the duration is higher. It will typically maturity period is higher, duration is higher. It leads to uncertainty about the future payments, right? If a payment has to be received tomorrow, the uncertainty is lesser, but if it has to receive after 5 years, some kind of uncertainty is getting built in. So that's the reason the spread is going to increase. So we see the difference between the bid and ask prices also typically going to mount up for securities which are having the longer maturity periods. So this is where we'll try to analyze what is called as credit curves or spread curves. Just like the way we call the yield curves where we plot with different maturity periods, we plot the yields. Here I plot the yield spreads. And generally as maturity is increasing, the yield spread is also increasing. So we see that it is more and more of upward sloping itself. And if the spread is widening, we see that the bond performance is going lesser and lesser, so the prices are dropping down. If the spread is narrowing, we see that the bond performance improves. So some of the things associated with the bond performance, linking it with respect to the spreads and the yields, and the thorough understanding of that is very much necessary part of the credit analysis. All right. Now let's look at special considerations that we really need to perform while evaluating different kinds of bonds. So here the focus is on high yield bonds. What are that additional considerations and care that needs to be looked at? And we would also look at sovereign bonds, how differently I need to look at them, and probably looking at even the municipal bonds as well. What is the kind of special treatment I have to go with each of these securities? So I will start off with the high yield bonds, otherwise being classified as the junk bonds, and they typically fall into the non-investment grade. So this part we know what we call as the high investment bond. So the credit risk is much higher in these kind of bonds, and what we see is a lot of things could contribute to it. Probably the leverage the company is going with is much higher. The debt to equity ratio could be drastically higher. So that could have contributed to for the rating agencies to classify it as a non-investment grade. The historical performance of the company is not generating any kind of profits, or nor it is giving any kind of indication of profits for the future. The whole overall the industry in which that particular company is operating is completely going down. The industry itself is in a very bad position, and whatever the competitive advantage the company is having, whatever is the core competence of the company, it is typically not getting used up to generate the profits. The free cash flow to the firm of this particular company are always negative, or even if they are positive, they are much lower, which means the ability to pay off the debts is still not turning positive. and it's a very heavy cyclically dependent kind of a firm. So probably there is a very heavy volatility with respect to its revenues and earnings, and the management is not able to come out with some kind of mechanisms which can improve the performance of the firm. And finally, the company has lots and lots of hidden off balance sheet kind of transactions which are not coming into the balance sheet to typically assess the performance. So there could be various other reasons also that could be visualized, fair enough, but the high yield bonds, the credit risk is high, so the probability of default for these kind of bonds is much higher. And because of this, the loss severity also, which is more interrelated with the probability of default, the loss severity also could be much higher. So the analyst has to really focus specifically on the issues relating to the loss severity, and apart from that, there is an in-depth analysis that needs to be performed with respect to the liquidity of these kind of companies which have issued high yield debt. Because majority of the times these companies, they cannot borrow more because they already are at the very high end. So borrowing more is not a source of funds for this particular company. And in general, these kind of companies are having more and more private ownership rather than a publicly traded, so they can't typically access the equity markets also to raise the capital. So any kind of negative news that is operating for this particular company makes it into a very pathetic situation, and probably it dries up the entire liquidity of this particular firm. And even not just the news about this company, even the negative news about the industry itself, these kind of companies are going to get very badly affected by these by this negative news. So the focus of liquidity is very essential for assessing the worthiness of these companies. So look out if the cash and other liquid mechanisms are there on the balance sheet of the firm. What is the effectiveness of the working capital from the balance sheet? The current assets minus the current liabilities. Is it positive or negative? By how much is it positive? What is the kind of cash flows that the firm is generating from the operations? Because they are the ones that should typically be used as a base for payment towards the debt and other payments. Any other external guarantees that are there? What is the kind of access this company has towards bank credit? Right? What are the kinds of accessing the short term access to the short term capital sources the firm is having in the external market? Does it have any kind of lines of credit arrangements with the banks? So just trying to explore that aspect. If it has some kind of an equity, by what extent the equity is issued, because majority of times we see they most of them are privately owned. But in case something have equity, probably what is the extent, and to what extent the assets of the firm can be sold off to generate the cash. So these are all more primary sources of liquidity, but these can go as secondary sources which could even deteriorate the performance. And what we could clearly see is in some kind of cases, especially when the economy is not doing good, especially when the industry is down, it might very much happen that at one single point in time or in a very short period of time, the company may have to pay a significant amount. And if it does not have any of these external sources of financing, it could very well go closer to a default or a wind up. And so if there is no other refinancing option, probably servicing the existing debt becomes very critical and that is where these firms can very comfortably go into a default. And one more thing that needs to be observed from the liquidity perspective is long-term assets funded with short-term liabilities. A very, very tricky situation, and liquidity becomes very tightly locked up in this case. So long-term assets as a proportion of the short-term liabilities need to be visualized to understand the creditworthiness of these high-yield bond issuing companies. So all these things need to be looked at from a specialized perspective to evaluate the worthiness of these firms. Apart from that, we talk about the projections of the financial statements, right? In the projections of the financial statements, look out for very heavy stress scenarios. Stress tests need to be performed on the projection. Look at all possible potential negatives that can typically come out based on the financial projections that are coming out. And a special focus on the debt structure. How much is it senior subordinated kind of a structure? What proportion of it is senior debt? What proportion is it subordinate? So different, what are the different layers of seniority that are present in it? And if possible, calculate the leverage for each level of the debt structure. So debt to equity or debt to total capital computed for each level, which means a senior secured debt, what is the debt to total capital ratio? For a senior unsecured debt, find out what is the debt to total capital ratio, or what is the total debt to EBITDA ratio. What is the total for the complete debt? Find out what is the total debt to either the total capital or the EBITDA kind of ratios. Try computing it for each of the levels in the debt structure, because each level has a different recovery rate here. Probably the most senior debt is having a much higher recovery rate compared to the most junior and the subordinated debt. And one more important thing, right? Especially if a company is having a secured debt, right? And that too, a large proportion of the secured. Probably the unsecured will be much more riskier, because obviously that the key asset is going as a collateral towards the secured debt, and the remaining whatever may not generate any kind of a value. So those kind of firms are typically classified as top heavy, and they cannot borrow new as a part of in case of financial distress. They may not be able to do any kind of borrowings, and they are very heavily likely to default, especially for the unsecured debt issues, and the recovery rates are going to be much lower because their majority proportion is a secured debt, and the key assets of the company might have been provided as a part, might have been collateralized as a part of the secured debt. So the amount of payment towards the unsecured debt is going to worsen off, and the default is going to be highly probable in that case. And one more important dimension that needs to be evaluated for high yield debt issuing companies is the corporate structure. All I need to see is, do they have any kind of holding company and subsidiaries kind of structure, parent and subsidiaries kind of a structure? Because in general, whenever we have this kind of a structure, we see that the subsidiaries part a portion of the dividend as the cash flows to the holding company, so the main earning source of this holding company is the subsidiaries itself. The holding company must be having the debt and equity structure of its own, but the major source of revenue is the different subsidiaries that are getting added up. And if there are and if the subsidiaries also are having a different debt and equity structures, because of this structural subordination, right? If there is a structural subordination, whatever the dividend payment that is going to the payment that is going to the parent, it is considered as subordinated after all the debts of the subsidiary are being paid off, right? So which means from the parent's perspective, from the dividend that it receives from the subsidiary one may be much lesser, and it may not be sufficient to pay the debt payments at all. That could trigger the kind of a default from the parent. But the parent is having multiple sources of revenues from multiple subsidiaries. So because of that, it might very much be possible that the credit rating of the parent might be much better off compared to that of the subsidiaries in some cases. And in some cases, the default of one subsidiary need not trigger a cross default. Right? This subsidiary may not result in this subsidiary defaulting and vice versa. So, very critically, all these things need to be evaluated. And what are the covenants that are associated with this kind of high yield bonds? Is there any kind of a put provision that is built into it? Put provision allows the investors to sell back the security to the company at a specific price, which means it will force the company to typically buy back the shares, especially in case of an acquisition. Something going wrong, the value going down drastically, right? And especially in case of high yield bond, this kind of a provision could be there, but for investment bond, this provision could be triggered only when after the acquisition it results in a rating downgrade from investment grade to a non-investment grade. This put provision can be triggered. In some cases, the covenants can talk about the restriction in terms of the payments that can be provided to the equity investors, either in the form of regular dividend or in the form of special dividends. And the amount of secured debt that could be carried, there could be some kind of a limitation, because the higher is the secured debt that is there, the more is the credit risk that is associated for the unsecured debt investors, because that is what we have seen earlier. If the proportion of the secured debt is much higher, the chances of loss for the unsecured investors are going to be much higher. And also check out whether the subsidiaries are restricted or unrestricted. When I am talking about the restricted subsidiaries, what we could clearly see is the cash flows of them can very well be used to service the debt of the parent, right? Whatever the cash flows, the profit, the assets of the subsidiary can very well be used to service the debt of the parent, which means from a parent perspective, the bond investors, they are very happy because their debt is not looked at as a subordinated from the subsidiary's perspective. It is looked at par from the subsidiary's perspective. So the covenants, what kind of covenants are there as a part of the indenture, they need to be looked at. And more specifically, compared to bond covenants, we also need to look at what are the covenants that are set up by the banks, because they are more and more restrictive. The reason being, any violation, the bank can block the additional loans until a kind of improvement comes out, and until the numbers are back to the initially agreed kind of numbers, right? And we see that high yield bonds, they have more and more of correlation with respect to the equity market. So whenever we are doing the valuation of the high yield bonds, we can look at the computation of the enterprise value, which actually is computed per evaluation of the equities also, which looks at the market capitalization of the equity market plus the total debt minus the cash, talking about the enterprise value. And this can be compared with respect to this is enterprise value by EBITDA, and another ratio, debt by EBITDA, can be computed, and the difference between these two can be looked at. The difference between these two is a clear assessment of the portion of equity, and the higher is the equity, I can very much associate that the lesser is the credit risk. So for high yield bonds, a different kinds of evaluation, taking into consideration all these various aspects, should typically come out, right? Now, the next thing I can look at is a sovereign debt. Obviously, from a sovereign debt perspective, the loan that is issued by the government, national government of a company. So here the focus is more on what is the ability of the government to repay, and more importantly, it's the willingness of the government to repay, right? Because willingness is very important from a government perspective, because if the government itself defaults, there is nothing to go legal against the government. So majorly the willingness is something that needs to be evaluated. So what is the kind of policies the government typically having with respect to the payment? What are the typical corruption levels that are present in the country? Right? What is the kind of commitment the government is typically showing to pay the interest and principals to the investors? What, from an economic perspective, how is the economy growing? What are the prospects of growth? How is the demographic situation of the country changing during this period, right? And the GDP per capita kind of changes, how they are trending over the past few years, and government versus private economy. What is the typical sizing of this? Then looking at it from an international perspective, what is the exchange rate volatility of the currency with respect to the other currencies? What are the foreign reserves that are there for this particular country of different established currencies? What is the proportion of the external debt as a proportion of the GDP or as a proportion of the total debt? From a fiscal perspective, what are the availabilities for the government to increase the revenue or to decrease the expenditure, right? And what is the kind of trend that is observed in that particular stuff? And finally, what is the kind of flexibility that the government is having with respect to monetary policy? What is the kind of flexibility that it is giving? All these things play a very key role in assessing the ability as well as the flexibility of the country. So that's where, from a credit rating agency's perspective, we see two kinds of ratings. One is a local currency based debt rating, and the other one is a foreign currency based debt rating. And as an observation, we can clearly see that the local currency based debt rating is much more effective. Higher will be the rating in general, whereas the foreign currency rating is always lower. So the credit risk is much higher in a foreign currency debt, whereas it is slightly lesser in a local currency debt. Again, the reason is, in the local currency debt, there is a lot of control for the government itself. It can either increase the taxes and collect and make the payments, or it can decrease the expenditures on various social welfare programs and it can make the payment, or if not, it can even print more money to typically go ahead with the payment. But when it has to look at from a foreign currencies perspective, it has to typically purchase the foreign currency, and in the open market operations, in the open market, the foreign currency need to be purchased, which could very clearly result in the local currency can depreciate because of that, because it has to purchase high volumes of the foreign currency by selling the local currency. So the local currency's value is getting more and more depreciated corresponding to the foreign currency, which will create the risk and which could trigger the default in the foreign currency market. So that is where we see that the foreign currency ratings are traditionally lower compared to the local currency rating, and any kind of defaults that are coming up apart from the various willingness related scenarios, some kind of political disturbances like wars and or some kind of natural national calamities that are natural based national calamities that are coming up, even they can make the overall government default on its loans. And if there is some kind of a devaluation of the currency going on a very heavy note, even that could trigger the default. And the export market doing very badly, even that could create a very negative signal in terms of the government's ability and the willingness to pay the debt. So, from a sovereign debt perspective or a sovereign credit analysis, this dimension really needs to be looked at. And finally, when I'm looking at the municipal bonds, okay, even these are government itself, but not national government, state government, or they could be issued by they could be issued by counties or state governments or local governments, any of them. Generally, compared to the corporate bonds, their default rates are much lesser. But the only thing that we really need to look at is the kind of bonds that are issued here. They could be classified as either general obligation based bonds, or I can look at them as revenue bonds. Now, revenue bonds are more and more associated with bonds that are issued to finance some exclusive projects. So the revenue that comes out from these projects is used to pay for the bonds. No other source of revenue of the government is used to pay for these bonds. So the performance of the project is very important. So they are more and more like recourse kind, non-recourse kind of bonds. Only the only the performance of the project makes a very important decision criteria, not the paying capacity of the government. So because of that reason, the credit risk is slightly higher, because and the evaluation is as good as a project evaluation which we do for a corporate bond. Similar kind of an analysis need to be done for the revenue based bonds. But when I look at the general obligation kind of bonds, it is a general revenue of the government. So it's purely from the taxing, because one, it can't print currency. So only from the way they are able to raise the taxes and control the expenses, they can typically make the payment towards the bonds. So, how well the local economy is functioning, what kind of employment opportunities are there, how the taxes are being collected, what is the kind of what are the kinds of facilities the local government is providing in terms of creating new jobs, what is the demographic structure, how is the government performing with respect to the economic cycle. All these kind of things typically needs to be evaluated in terms of understanding the paying capacity of the government towards the service of the debt. And typically in case of the revenue based bonds, it is just like a commercial project evaluation. We will look at debt service coverage ratio, and the higher and higher are the ratios, obviously the lower is the default risk that is associated with them. So different kinds of these bonds, especially the high yield bonds, the municipal bonds, the sovereign bonds, they have a decent amount of differences in their structure, differences in the way they make the payment. So from a credit analysis perspective, each of them needs to be dealt in a completely different manner. So understanding the traditional characteristics of each of them will really help the analyst in doing a much better sophisticated credit analysis. All right.